Hi, everyone. My name is Greg Steffler, and I have a passion for investing. And recently, I made the decision that I wanted to share some of the experiences and the education that I've learned over the years with the general public via social media because I thought I had a unique perspective. So, my background is basically that I was originally in law, and I did that for a couple of years. And then I went back and got an MBA, and I transitioned into working in investments. And then after that, I decided to become an entrepreneur. But throughout all those different experiences, investing has been the thing that has always brought me joy and enjoyment. And it's something I do for fun. And making these videos hopefully will be fun. And before I could even kind of make some introductory videos, I was working on a project that I thought had an interesting lesson. So I said, you know what, let's go ahead and try and film this and put it out there and see what happens. So I was reading an article that basically was talking about how Reddit was going to IPO soon. And I just thought, okay, well, let me see if there's an investment opportunity there. And obviously Reddit is a huge, community of people that post different, a variety of topics and post their opinions and thoughts on, a whole variety of different topics. And it's user driven. It's kind of a sense of community. And obviously with, the meme stocks that went crazy, they got a lot more popular. So these were kind of some of the reasons why I was like, well, let me, check it out. I didn't know anything really about the company. And so I I started to dive into it. And one of the things that I do when I start to dive into a company is I kind of do what I would say is like a red flag analysis. I kind of look for things that would suggest that I'm not interested in buying the particular stock or business. And, there's no real kind of system. I have some, experience that I sort of look for certain things. And so I kind of just wanted to share some of the things that I came across with Reddit and, share with you why I think they may or may not be important, but, we can kind of debate that later on. So, Reddit, obviously, as you can see, their mantra is dive into anything. So I decided to dive in. So you can go to the SEC website, sec.gov or Edgar, which is the one I'm using right here. And we can just search for Reddit and it comes up as RDT. DT is going to be this ticker. And because they're not publicly traded, they have to file these S1s, which is the kind of the equivalent of a 10K. It's going to be a very large registration statement, as you see. That's going to tell you all the different background business, anything you want to know about the company is going to be in this document. So this is where I started. And there was a couple things that I didn't know from the beginning. I didn't really know much about the company. So they're going to give you a bunch of statistics here, about how active the community is, how many average daily users, about 73 million in December. And the thing that's caught me first, and this was kind of my first sort of red flag a little bit, was that the company was actually founded in 2005, which I didn't know. I just thought it was a newer company. And so the question then is like, well, why are they going public now? I'm like, it's a pretty long time. And, what is the state of the business and how, has something changed or whatever? So that was just kind of like, it's kind of just saying, okay, well, it's unusual, not unheard of for a company to have been around that long and then all of a sudden decided to go public. So, when we kind of go down and we get to the table of contents, and I kind of was like, okay, the first thing that I wanted to see was I just wanted to know basic, like what are they going to use this money for? Like, what is their plan? So we click on the use of proceeds, and it's a fairly, couple paragraphs, nothing too substantial. And in the first sentence, they tell you that they're going to raise anywhere from $450 million to $552 million, depending on the price and how many shares they actually land up selling in the underwriting. And the part that started kind of standing out for me was there was this particular paragraph where it's going to tell you that right over here that they're going to use $195 million of this $450 to $500 million to basically satisfy this tax obligations, these net settlements that they have. And then they tell you that there's going to be another 11 million or so. I believe it's in this paragraph right here, another 11 million. So out of this, $500 million, something like, $205 million of this is going to be used to settle these obligations as a result of some of these restricted stock that they have. It's not really like important, what they're doing with the money. But the point is that over half of the money is not actually going into the business to be, to develop some new product or to advertise or anything like that. It's just basically being used to, pay kind of these RSU net settlements, which to me wasn't very attractive. But again, it's just kind of one of these red flags. That's nothing. It doesn't make or break an investment. It just kind of starts to add up over time that this might not be something that I'm interested in particular. And I thought, okay, well, that seems odd too, because then, do they have cash? Do they have a lot of cash? Do they not have cash? Usually you IPO and you need the money for some sort of purpose to drive either revenue growth or drive business opportunities, whether you want to acquire someone or acquire a division. So come back up to the table of contents, and I went down to another area that I always kind of go to first is this area called certain relationships and related party transactions. And this just tells you what they're doing, the people that are connected to the company, what they're doing, because they have to disclose this. And so here's where it starts getting kind of interesting, is that they tell you that in February 2021, they did a deal, and it was a preferred stock deal for $518 million is what they raised. And then in August, they come down here, they did another deal, August 2021, for $410 million. So they've raised, in these two transactions alone, something like $928 million. And I thought, okay, well, that's kind of crazy. Now they're raising $450 to $500 million, but they've already raised $900 million. And again, that's great. Like, they've been able to raise a lot of capital. Like, that should be a good thing. So from there, we can go back up to the table of contents. And I'm going to go to the index of consolidated financial statements. This is where they're going to have all the different financial statements. And this is, again, I kind of go to this next to kind of just get a sense of the overall business. And if I was to really want to invest in this company, I would read the whole thing from the beginning to the end and kind of focus on areas that are interesting. But this is like a cursory kind of, let me see if this is something I want to spend some time on. So the balance sheet, we can see, is it's super cash heavy. So these two, the cash and cash equivalents and marketable securities for December 31st, 2023 is almost $1.2 billion in itself. And that's not taking into account the $450 million that they're going to do in the IPO. Okay, that's great. They have a huge cash business, a lot of liquidity, at least it looks like. So the balance sheet actually looks really great because there's no liabilities. They basically have $133 million in liabilities. So they have a ton of cash. And you kind of go back, kind of makes you kind of just stop and think, okay, like, so far that's not bad. Like, you have a lot of cash. Like, okay, that's a good thing. Like, I always love a company that has more cash and not a lot of debt. So I would say that's a good thing. However, what happens is when you come down to the revenue statement. So here we go, how this company is going to earn money, which is, kind of just interesting to understand how they make money, how they spend money. So the revenue for 2023 is going to be around $804 million. Now, their expenses on that, their total expenses were $944 million, meaning they had a $140 million loss. That's the part that kind of scares me. And this is where I kind of started getting a little more like, I don't think this is a great investment. In the previous year, in 2022, they lost $172 million, which we can see here. And they had done $666 million in revenue, and the costs were $838 million. Okay, so what this means is that they're growing their revenue, is great, but the cost to run this thing is so high. They're spending $944 million in 2023 to run this thing, to run this whole website and everything. And I'm not a particular fan of how they're doing their expenses. It may be the technically correct way to do it. This document doesn't provide enough information to really make it, a determinative, opinion on whether or not they're doing it correctly. So what they're doing is they're showing their cost of the revenue is only $111 million. And they're saying that they spend $438 million on research and development. We'll just step back and kind of let's think about this. Research and development we typically see in like pharmaceutical companies. or big tech companies or even software companies will have, research and development. And the idea is that if you were spending money up front and you have to have you spending a lot of money to make, some sort of new product or some sort of new widget, that then over time, when you release that product, your expenses are going to go down because you don't need to invest in R&D anymore. And you're just going to utilize that previous money you've spent to increase your revenue. So things like a pharmaceutical company, for example, they're going to spend a lot of money on R&D. And when they come up with a drug that's going to be successful, the actual cost of manufacturing the drug is really low. And they're now going to gain that profit later on. So that's kind of what I think they're trying to make it look like they're doing. Like they have this big research development team, and I'll show you why. So you can go down to, we're going to go after all the statements. They're going to start to explain every line item that comes up and what it means. So on F9, they're going to tell you what our revenue is. So, their primary revenue is from advertising, right? That makes sense. So, and that's the bulk of their revenue is they generate, advertising. The other revenue they have, which is this line, because maybe they were investing to get some new sort of revenue, some sort of, something that maybe in the future is going to be really worthwhile, is they're basically doing data licensing, and then they're going to have premium subscriptions, and that's in this other revenue line. So it's nothing kind of that they haven't done in the past, 20 years or so, or 17 years that they've been around. So the cost of revenue then is, they tell you that the cost of the revenue, which was the lowest number, right, is to third parties for the hosting and supporting the mobile applications. Okay, so back end stuff, no problem with that. It also includes, the delivery of their advertising, meaning when they show ads, the cost of doing that. And then cost of revenue consists of personnel-related costs, salary, benefits, and stock-based compensation. That's pretty normal. However, so now we get to the research and development portion of this. So now they say that the research and development expenses consist primarily of personnel-related costs, including salaries, benefits, and stock-based compensation for engineers and other employees engaged in research and design and development of new and existing products. Okay, well, that's if your revenues are generated, which the revenues, we can go back up, are being substantially driven by advertising, right? And we can see that they'll break down the what the revenues are. Let me get to it on F15. 1 second. So here's the breakdown of revenue, right? So 788 million of that revenue is advertising revenue. Totally makes sense. This other revenue, this data subscription and the premium subscriptions and the data is only $15 million. So if they're generating revenue from advertising, yet they're saying that the cost of the revenue includes some personnel, but that the R&D expenses are now holding personnel related to engineers engaged in the research and design of new products. I don't think that really makes sense to me. Now, they have another line item that says sales and marketing expenses. And this is for the sales side of the business. Okay, the sales side of the business, I don't really have a problem with that. Sales commissions, that's the guys that are probably going out and making the advertising deals. But again, you just got to step back and think, does this make sense? And then they have just general, kind of administrative expenses right here, which is, legal people, human resources, information technology, anything that's not really directly related to the advertising. So to me, again, it's my opinion and just sort of based on my experience that these numbers don't make. It's not that they're being fraudulent or being illegal. I think they're just kind of pushing the gray zone of this idea that the cost of this revenue is only $111 million. They're generating, $800 million in revenue off a $111 million investment. That's great. But the research and development, they're trying to, in my opinion, again, I want to make sure I'm very clear about this. It's my opinion on this, is that they're trying to make it seem like they're investing all this money into these projects that are going to be profitable in the future. And it just kind of adds to the story of that this company's been around since 2005. They've raised capital fairly recently, right? They're not profitable. And yet, during the meme craziness that went on, Reddit was everywhere. So Reddit was huge, and they were, they're kind of, maybe, let's say, we're at their peak eyeballs, maybe, right? And yet they're now saying that the research and development is where the costs are going. Again, I'm not, accounting can be very specific, and there may be a very specific rational reason for this, but the story doesn't seem to add up to me to become what we would say, like, is a really good investment opportunity, because this company is losing money. They're losing, $140 million. They seem to have always been losing money. We don't have a lot of the past data to make any kind of assumptions on, what would change or what we need. So I just went one step further. Right now, I was like, okay, I'm kind of off off not wanting to invest in this company. So, and there's one more point I want to do in this S1 that I want to show you, is the letter from the CEO, co-founder. So this letter from the co-founder, and he kind of ends this letter. Let's see. So. Oh, wait, sorry. No, sorry. It doesn't end. It's in the middle. So it starts with this paragraph that says, we're going public to advance our mission and become a stronger company. Okay. We hope by going public, we provide meaningful benefits to our community as well. Our users have a deep sense of ownership over the communities that they create on Reddit. The sense of the ownership often extends to all of Reddit. And then, they kind of keep going on. And that by becoming a public company, we want the sense of ownership to be reflected in real ownership for our users to be our owners. It's not like he's pitching this as this is a great business opportunity. He's pitching is that he's rewarding the users, which I'm not saying there's anything wrong with. I don't have any problem with someone who wants to do that, but that doesn't mean it's a good investment necessarily. And so when I kind of add up this whole story that I have, that I've sort of presented, it just doesn't seem like it's going to be a good investment opportunity. Now, that doesn't mean that the price of the stock won't go up, from a trading standpoint, as people rush in the IPO. I could be wrong in the long-term success of the business. I'm not saying that. But as at this point in this S1 that we have, I just don't see it. And I went one step further. And so I took the revenue numbers that were in that S1, and I said, okay, like, how much do we have to grow again to kind of get to a break even, so we know when we're stop losing money? And so, I created this 2024 estimate, and right now the assumptions are 0, which is why it's mirroring what happened in 2023. So if we assume that revenue were to continue to grow at, let's say, a rate of 15%, the company, you can see down here, is going to still lose money. Okay, and that assumes that the costs don't change, right? That the costs don't go up, and we know that's not going to be necessarily true because of inflation and all these things, and workers want more salaries. It's a competitive industry in terms of getting engineers and all that. They're competing against Facebook, Google, everybody who's getting engineers. So let's assume that the costs go up by 3%. Okay, so now we're back to losing $47 million a year. Now, it's not a huge burn rate relative to the cash position that they have, but it just, if we assume a 20% growth rate, they're kind of getting close to break even. And again, the 3% might be low. We might say it's like 5. But the issue I have is, like, well, what happens if the revenues come at like 10%? Like, just to kind of that peak eyeball kind of concept, is the case. And maybe 10% with growth rate and revenues, and we're just looking at 1 year, and 5% costs, kind of going up, sort of just to keep up with salaries and expenses and insurance and all that stuff. They could be burning $106 million. So for me, it was just kind of all these things add up that this opportunity in Reddit isn't that attractive. And I just wanted to share that kind of process that I walk through with you. And so hopefully you can use this to make kind of better investment decisions going forward.